Hello everyone, this is Nalini ND, Assistant Professor, Department of Commerce, GFGC, Madhugiri, Tumkur District. Now I am going to discuss about Working Capital Management, which is 5th unit in AFM subject, Advanced Financial Management subject, 6th semester, BCom, CBCS, Tumkur University, Tumkur. So generally, first let us discuss the capital is required for business can be categorized into two. One is fixed capital, another one is working capital. So every business needs funds for two purposes: for its establishment and to carry out its day-to-day operation. Long-term funds are required to create the production facilities through the purchase of fixed assets such as plant and machinery, land and building. Then comes the working capital. So working capital is required to meet the day-to-day operations of the business. Coming to the definitions, in the words of Shubin, working capital is the amount of funds necessary to cover the cost of operating the enterprise. According to Jenistenberg, circulating capital means current assets of a company that are changed in the ordinary course of business from one form to another, as for example from cash to inventories. So inventories we mean raw materials, work in progress, stores and spares and finished goods. Then inventories to receivables and receivables into cash. Classification or kinds of working capital. First one, gross working capital. The gross working capital is the capital invested in total current assets of the enterprise. So gross working capital is equal to total current assets. So what do you mean by current assets? Current assets are the assets which are converted into cash within a short period, say 12 months. So then comes the components of current assets. The components of current assets includes cash in hand, cash at bank, debtors, bills receivables, prepaid expenses, stock or inventory, which includes raw materials, work in progress, stores and spares, finished goods. Second type of working capital is net working capital. Net working capital is the excess of current assets over current liabilities. Net working capital equals current assets minus current liabilities. So here we have understood what you mean by current assets. Next we'll understand what is current liabilities. Current liabilities means liabilities to be discharged or disposed of within a period of 1 year. So then comes the components of current liabilities: bills payable, sundry creditors, accrued or outstanding expenses, short-term loans, dividends payable, bank overdraft, provision for taxation if it does not amount to appropriation of profit. These are current liabilities. So net working capital is equal to current assets minus current liabilities. Net working capital may be positive or negative. When the current assets exceed current liabilities, the working capital is positive. When current liabilities are more than the current assets, then it is said to be negative. Permanent working capital. Permanent or fixed working capital is the minimum amount which is required to ensure effective utilization of fixed facilities and for maintaining the circulation of current assets. There is also always a minimum level of current assets which is continuously required by the enterprises to carry out its normal business operations. So for example, every firm has to maintain a minimum level of raw materials or work in progress or finished goods and cash balances. This minimum level of current assets is called permanent or fixed working capital, as this part of capital is permanently blocked in current assets.